You know that moment. You're sitting there, maybe late at night, maybe half distracted, applying for a credit card online. You've already clicked through about 17 screens you didn't really read. Interest rates, terms, rewards, the usual blur. And then suddenly, there it is, a little box. Would you like to protect your balance with credit card insurance? And for a second, just a second, your brain goes, wait, should I? Because what if something happens? What if you lose your job? What if you get sick? What if life just does that thing it does where it knocks you sideways when you weren't looking? Honestly, I've been there. My name is Nick, and I spend way too much time thinking about money, financial psychology, and the weird little traps that quietly drain people's bank accounts while sounding completely reasonable on the surface. And credit card insurance? It's one of the sneakiest. Because on paper, it feels responsible, adult, prudence, like you're being the kind of person who has their life together. But once you actually peel back the layers, and we will, you start to realize something a little uncomfortable. For most people, it's basically a very expensive illusion of safety. And by the end of this, you're probably going to look at that little checkbox very differently. Section 1. The emotional hook they're counting on. Let's start with the part nobody says out loud. Credit card insurance is not primarily sold with math. It's sold with fear. Think about the exact moment they offer it to you. You've just been approved for credit, which already creates this subtle sense of responsibility, and then they slide in this gentle little nudge. What if something happens and you can't pay? And suddenly, your brain jumps to worst-case scenarios. Job loss, medical emergency, unexpected life chaos. Yeah, that gets your attention. But here's the thing most people miss. Insurance products, especially these small add-ons, are designed around probabilities, not possibilities. Could something bad happen? Of course. But the real question is, how likely is it, and what are you actually getting for what you pay? Because emotionally, this feels like buying a safety net. Mathematically, it often behaves more like a slow leak in your wallet. And honestly, the banks know exactly what they're doing here. Why this matters to you: if you understand the emotional trigger, you're far less likely to make a fear-based money decision. Takeaway: anytime a financial product is presented right after a moment of approval or relief, pause. That's usually when your guard is lowest. Section 2. The cost is sneakier than it looks. Now, let's talk about the part that makes financial nerds, yes, including me, quietly sigh. The pricing. Most credit card insurance plans charge something that sounds harmless. Maybe it's 99 cents per $100 of balance, or 1% of your monthly balance, or some similarly tiny number. And your brain goes, oh, that's basically nothing. But here's where it gets interesting. Let's say you carry a $3,000 balance. A 1% monthly insurance fee means you're paying about $30 per month. Doesn't sound catastrophic, right? But stretch that over a year. That's $360. Over 5 years, $1,800. And here's the kicker. And honestly, this is the part that bugs me the most. Many people paying for credit card insurance never actually use it. Not because they're lucky, because qualifying is harder than it seems. Why this matters? Small monthly fees compound into very real money. Takeaway: always annualize monthly fees. Your brain underestimates small recurring costs. Okay, quick, honest moment. Have you ever, really, read the full insurance terms when signing up for something like this? Yeah, most people haven't, and I get it. These documents are basically written in what I like to call legal fog. You start reading, and somewhere around paragraph 4, your eyes just politely give up. But buried in that fog are the real rules. Common restrictions often include things like you must lose your job involuntarily. You may need to be unemployed for a waiting period. Pre-existing medical conditions might not qualify. Benefits may be capped. Coverage duration may be limited. So the marketing says, we've got you covered, but the contract quietly whispers, under very specific circumstances. I once looked at a sample policy, and honestly, it was almost impressive how narrow the qualifying window was. It's like those carnival games where the hoop looks big until you actually try to throw the ring. Why this matters? Coverage that rarely triggers is functionally expensive. Takeaway: if insurance requires multiple specific conditions to activate, treat it with healthy skepticism. Section 4. You already have better protection. Probably. Here's where things get quietly ironic. Many people who buy credit card insurance already have stronger financial protection elsewhere. They just don't connect the dots. For example, emergency savings, disability insurance through work, health insurance, unemployment benefits, depending on location, income protection policies. But when the credit card prompt appears, your brain treats it like a brand new risk. It feels urgent, immediate, personal. And that's partly because it's framed in isolation. Nobody pops up and says, "Hey, before you buy this, quick reminder, you may already be covered in 3 different ways." Because, well, you can probably guess why. Now, to be fair, and I want to be balanced here, there are edge cases where someone with zero safety net and highly unstable income might find limited value. But for the vast majority of reasonably stable cardholders, it's redundant protection at a premium price. Why this matters? Overlapping insurance is one of the most silent money drains. Takeaway: before buying any new protection product, inventory what you already have. Section 5. The behavioral trap nobody talks about. This one's subtle and honestly a little uncomfortable. Credit card insurance can sometimes create a psychological side effect that works against you. It can make carrying a balance feel safer. Not consciously, but just enough to matter. Because once you've paid for protection, your brain relaxes slightly around the risk of debt. It's the same weird human tendency that makes people drive a bit faster when they feel safer in a newer car. Risk compensation is real, and I've seen this pattern over and over. People with balance insurance often stay in debt longer than people who don't have it. Not always, but often enough to raise an eyebrow. Because the real financial win with credit cards is simple, almost boring, honestly. Pay the balance off, avoid interest, move on with your life. Credit card insurance doesn't help you do that. Why this matters? Anything that makes debt feel more comfortable deserves scrutiny. Takeaway: financial tools should push you toward better behavior, not cushion bad habits. Okay, so if credit card insurance is usually a poor deal, what's the smarter move? Honestly, the answer is refreshingly simple. If you took that same monthly insurance cost, say $20 to $40, and redirected it into something boring but powerful, like a basic emergency fund, a high-yield savings account, paying down your balance faster, building a small cash buffer, you'd typically end up in a much stronger position. Because here's the quiet truth about personal finance that doesn't get enough airtime. Liquidity beats conditional promises. Cash you control is usually more flexible than coverage you have to qualify for. And yeah, building savings isn't as emotionally comforting as buying insurance in the moment. It doesn't give you that instant, "I handled it" feeling. But over time, it works better. Much better. Why this matters? Direct financial resilience usually outperforms niche insurance add-ons. Takeaway: when in doubt, build cash buffers before buying micro-insurance products. Section 7. When it might make sense. Rare but fair. Now look, I don't love absolute statements in finance, so let's be fair for a second. There are narrow scenarios where someone might reasonably consider credit card insurance. Maybe someone has no emergency fund, highly volatile income, no disability or job protection, and carries a necessary balance temporarily. Even then, I'd still want them to run the numbers carefully and read every line of the policy, because the bar for this to make sense financially is higher than most marketing suggests. And honestly, if someone is financially fragile, the priority usually isn't adding another monthly expense, it's stabilizing cash flow and building a cushion. But nuance matters. Financial practice is personal, just not usually in the direction the brochure implies. Why this matters? Financial advice should allow for edge cases, but not let them drive the default decision. Takeaway: if you think you're the exception, double-check the math twice. Conclusion: the quiet shift that saves you money. So let's zoom out for a second. Credit card insurance isn't evil. It's not a scam in the dramatic, late-night infomercial sense. It exists, it pays out sometimes, it's legal. But for most people, it's like buying an umbrella that only opens if it rains on a Tuesday while you're standing on one foot and facing north. Technically useful, practically limited. What really protects you financially, and this is the part I wish more people heard earlier, is not stacking small insurance add-ons every time a company offers them. It's building margin in your life, a little cash buffer, a habit of paying balances down, a healthy skepticism when financial products show up wrapped in urgency and reassurance at the exact same time.